The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. A lot of news from big companies this week, team. First up, the boss of Fletcher Building explains what's behind a 46% drop in profit. And Ryman Healthcare launches a surprise capital raise, asking shareholders for $900 million. I asked the chief executive if he reckons he'll get it. You made it. It's Friday, February 17th, and you're watching Markets with Madison. Shares in Fletcher Building have suffered this week after the construction group revealed a profit drop and forward earnings downgrade. I spoke to Chief Executive Ross Taylor this week, and he said that drop covered up the success it actually experienced.
Well, I think it hides what's actually going on in the business because the drop in net earnings was due to the provisions we had to make on the convention centre last year. And when you through that to our first half, our materials and distribution businesses performed very strongly. You know, their margins, quantum and margins improved through the year nicely. That was a bit offset by our residential development business, which still performed well, but just from the softer housing market, it was lower levels of profit than last year. But when you net it all up, the overall business underlying improved profits, margins, and we've still got a very strong balance sheet and had an interim dividend of 18 cents fully imputed. So, yeah, I think it was a nice solid result apart from that convention centre issue.
Speaking on the convention centre, you've just recently provisioned an extra $150 million in costs to that vertical project. How much does that now take the total blowout cost of that project to?
We don't break it up. I mean, we just have, what we don't do with projects is get into specifics, and it's part confidential with clients, but also part, we don't want to overflag that because we've got a lot of negotiations to do with contractors and all those sorts of things. So we only ever talk about the overall provision envelope when we announce.
Is there a 0.001, if any, % risk that there could be more costs to come?
Oh, there's always risk. I mean, I'm confident, but there's never no risk. And our disclosures in our accounts say that, but we've put a lot of thought into it, and I gave you that backdrop to give you a sense of why I'm confident, but that doesn't mean there's no risk.
Can you tell me what you're seeing in the residential construction market at the moment? Is it becoming a bit more of a bust than a boom in the current cycle?
I wouldn't call it's certainly not a boom, but I don't think of it as a bust either. But to give you some colour around that, there's still two dynamics going on. If I talk about where we develop, build and sell houses, what you've seen since the sort of the heights, which were really the end of 2021, is the market's come back off, both in volume and in price points. And the overall market's down circa 20%. Our house prices are down 10 to 15. We're a bit different because our average house price is below the median, so it's a bit more solid there. And you've seen that in our margins now, because what's happened is our margins have gone from about 30% to around about 20%, which is more the long-term average. So what you're seeing now in that business is where we think we'll do about 800 this year. We thought we'd be around 1,000. So we're 20% down in volumes, and you can see the margins compressing. And we think that's about where it's going to settle. And we say that because in our other businesses where we sell into that market, we're seeing our customers, our frame and truss orders for other customers, what we're doing in civil works ready for making houses also down about that 20%. So we think the residential market therefore is going to come back from around about 37,000 houses built each year to probably about 31. And that's how we talked about our guidance looking forward. On the other parts of our business, and what I call our volume businesses, material and distribution, what we're seeing there is that's still busy because there's been a feature going on where there was too much to get built and there was a lag. So we had to clear all that. That's going to be broadly cleared, we think, by about mid-year. We think we'll stay pretty busy, and if anything, some of the rework from the recent Auckland or North Island flooding will probably bolster that a little bit. But then FY24, we'll start to see the volume businesses come back to where the real housing market is, which is about 20% lower.
You do have a new jib factory that's, I believe, about to come online soon. If there's a residential slowdown and there's no place to sell all of that jib to, could there be excess of supply following a jib crisis?
Well, our whole plan in building that facility, it's a 25, 50-year investment. So we are bringing that into the market at 50% more capacity than the market. So look, I always want a busier market, but the fact, and we just then flex the throughput to whatever the market needs, keeping a decent level of buffer stock. So yes, there'll be more than enough capacity there, and exactly how much depends on exactly where the market lands.
What's your margin on GIB currently?
We don't disclose that.
Overall in your materials division?
In our building products division, we do disclose the blended, and we're running at about 14%.
Any plans to increase that this year, Ross?
No, that's, look, we benchmark ourselves. If I look at the overall Fletcher Building margins and our different business lines, and that's operating well at that area, but we're not looking to get greedy with it either. So I think you've always got to keep that a bit in balance, because if you start making too much profit, that doesn't play well with our customers either. And without just sounding totally virtuous, we are kept very honest by what goes on in imports and competitors. So you just don't, so I think around the margin levels we are now is pretty good, and I don't see a lot of upside to that.
What size margin would be greedy? 20%, 30%?
I'm not going to speculate. I'm just talking. That was a conceptual statement without putting a dimension on it.
Best of luck with it, Ross. We'll keep in touch. Thanks so much for your time.
Thank you, Maddie.
The country's largest retirement village operator, Ryman Healthcare, needs $900 million to help repay an uncomfortable level of debt. The company announced a capital raise this week and will pump the brakes on its development pipeline, all things analysts say are desperately needed. I spoke to Ryman's chief executive, Richard Umbers, yesterday and asked him at what point he realised its finances needed fixing.
Well, the origin of our thinking is really more to do with us looking at the scale of the opportunity that sits before us. We know we've got some great traction in Australia, where we opened some 7 or 8 years ago. We also know that there's still significant opportunity in New Zealand with the demographic wave passing through. And we knew that we had to have a strong balance sheet to be able to capitalise on the opportunity that sits in front of us. That led us to doing quite a bit of business modelling, and that ultimately led to us making the announcement yesterday that we're looking to raise $900 million.
So when was that decision made behind closed doors?
Well, realistically, the governance process would be that it's only actually made formally the day before. But in terms of the modelling work and so on, we knew that in order to maintain the growth rates that we've enjoyed for a considerable period, we knew that we would have to bring more money into the business. Now, historically, we've typically done that by bringing on new debt. But obviously, with the increase in the interest rates and the current macroeconomic environment, there's a point at which we should consider equity raising as well as part of that capital structure.
Richard, it looks on the face of it like it was a last resort measure. Was it?
Oh, I don't think it's a last resort measure. We've been planning for growth. And if you're planning for growth, you need to have a strong balance sheet. And this was really, debt has been something that has been discussed quite a lot across analysts and other business commentators. And we wanted to take that issue off the table. And the best way to do that is to do an equity raise and make debt something that's no longer a point of discussion.
Yeah, on that, there will be a couple of analysts probably thinking this week, I told you so. Why did you not heed their concerns about your debt levels earlier and raise capital then?
Well, I've only been in the business just over a year, and the first step was to really get to understand it, to travel around the villages, to understand the scale of the opportunity that was in front of us. Everybody's obviously got opinions, but you need to take the time to form your own views. That obviously takes time. We then conduct the modelling work. And off the basis of all of that, we decided that the right strategy for the business was, in fact, to expand and continue our growth in Australia and in New Zealand.
Was Ryman at all close to breaching any of its debt covenants?
We certainly hadn't breached any, but when you model forward and you look at both the business volatility, the macroeconomic environment and the spend profile to capitalise on the opportunity, we certainly weren't happy with that level of risk into next year. So we did have discussions with the various lenders we had within the business. That included a USPP, but also an ITL and also our local banks. And in association with them, we made some adjustments to the covenants with the local banks and the ITL. And ultimately, as you'll have seen yesterday, we made the decision to pay down also the USPP.
Your net debt currently is sitting at $3 billion New Zealand dollars. After this capital raise, all going well, it'll reduce to $2.25 billion. How do you feel about that size of mortgage?
Well, we also set down yesterday that we wanted to keep our gearing ratio between 30 and 35%. And you'll notice that this comes in just under that threshold, so 34%. So it's in line with where we believe we should sit. And it's also broadly in line with other competitors in the marketplace who operate in our sector. So there would be nothing unusual with where it now sits. We'd also say that because it's linked to our plans to expand and grow the business, as we look forward and execute on those plans, we expect to see the cash flows improving into the business. And so over time, over several years, we would expect to track slightly lower into that bracket. So I think it's a very sensible positioning. It takes debt off the table. It's designed to make that issue go away. But also, we didn't want to over-raise, which we would also be criticised for. So this is a nice balance between capitalising on the opportunity while at the same time taking debt off the table.
What average interest rate are you paying on that debt, and is it floating, fixed, or a mix of both?
We use quite a number of different hedges, and we also map our debt out over several years. We have several packages of debt. The pay down of the USPP, which was longer term debt, clearly now significantly changes the profile. But each year we review the structure of our debt, the tenor of the debt that we've got over the coming years, and we make adjustments in association with our local banks. And we'll be doing that again this year as well to make sure that we have a sensible profile and not everything maturing at the same time.
What is a sensible interest rate to pay on $2.25 billion worth of debt?
Well, it changes over time, and that's why we put hedging in place. Particularly when we were borrowing offshore, we also used swaps as well to mitigate that risk. Obviously, just like a domestic mortgage, sometimes it's good to have a mixture of both floating and fixed debt. And in association with our board, we have a policy that identifies the acceptable level of risk, and we put hedging in to make sure that we're hedged. Typically, and in recent times, we've been approximately 50% hedged across our debt profile.
Can you give me an average interest rate that you're paying? Because I know that investors will absolutely be interested on the cost that you're paying on that debt.
We haven't shared it as it happens. But what I would say is that in paying down the USPP, we paid down our most expensive debt. So that situation actually improves. And also, we've made adjustments to the covenants we've got, and we enjoy very strong support from the local banks. So I believe we've got a good deal from them. And by paying down the USPP, we actually improved the position as well.
You're easing off your development pipeline as well. What are those 6 villages that are impacted by this?
What we actually did in the middle of last year was we realised that we ought to be pivoting towards a more efficient use of capital. It's not so much that we stopped a building site mid-process. What we're really deciding to do, that there are certain locations where we're not yet ready to justify the next phase or the next stage in that expansion, mainly because there are other opportunities we've got in the portfolio where we can get a better return. So from our point of view, rather than building another stage in one of our big locations in Auckland where we already have availability of stock, instead of that, perhaps accelerating our site down in Cambridge is a better way to go about it, and it would be a better use of the shareholders' funds.
Lastly, Richard, do you regret anything about the timing of this capital raise, given your current share price, or regret at all the amount of debt that you've loaded up on in recent years?
Well, unfortunately, you can't choose the circumstances under which you do things. The changes in the interest rates were certainly not something that we could have predicted. We couldn't have predicted COVID either. As as a business leader, I look at the market conditions as they are at the time, and we make our decisions accordingly based on what you know at the time. And when those conditions change, obviously, your decisions change with them. That's all about being nimble and competitive in the marketplace. And right now, the right thing to do is for raising the money and paying down our USPP and setting ourselves up for growth.
Reckon you'll get all $902 million?
I do, yes.
Hey, thanks so much for your time, Richard. Appreciate it.
Thank you very much.
Plenty of other listed companies reported this week, so here's their numbers too. SkyCity is back in black. Its profit booming now that tourists are back in the country. Contact Energy made a half-year net loss of $7 million, and that was due to recognising an onerous contract provision. Vulcan's profit was steady, but it is facing challenges with higher financing costs. And Steel & Tube, with a drop in profit, also expecting steel demand to continue to moderate. Let me know what you think of the company results we've seen so far and what questions you want me to ask executives next. Plenty more results to come next week, including A2 Milk, Spark, Freightways, Precinct Properties and Air New Zealand. Get all the numbers as they land on nzherald.co.nz. Now go put your money to work.